Investing for Beginners, Lesson 2, What is the stock market? In the last video we covered what stocks are, so now we will go over where they are traded and organized. The stock market in its simplest form is a market for buying and selling company stocks. Say a company has issued 100 stocks in total. Then each stock represents a 1% ownership in the company. So if you bought 51% of the shares of a company, then you would become the owner of that company. Sometimes you hear about hostile takeovers, and that is when a company doesn't want to be bought by another company, but they don't have a choice because the other company just buys 51% of the shares and becomes the owner. A stock market index is a way of measuring the value of a group of stocks within the stock market to better gauge how the stock market is doing as a whole. Investors use indices to compare their stock investment returns against these indices to see if they are outperforming the market. There are three major indices, and they are the Dow Jones Industrial Average, the S&P 500 Index, and the NASDAQ Composite Index. Now, the Dow Jones Industrial Average is also known as the Dow or just Dow, so those are sometimes the buzzwords around that average. And it is a weighted average of 30 major stocks, but it is not a direct average, so that is why it ranges around such a high number. It is also typically used as a barometer for the health of the market. This can be bad since people put too much weight into it and they begin to sell their shares as the Dow trends downward. The Standard & Poor's 500 index is a weighted average of over 500 stocks, so that can also be a good gauge because it's a much wider spectrum. And another major one is the NASDAQ Composite Index, which is a weighted average of all the stocks within the NASDAQ stock exchange, which I will explain coming up in the next few slides. The NASDAQ typically has technology stocks in it, so you can get a good gauge of technology-based stocks by reviewing the NASDAQ Composite Index. Stocks are separated into sectors, and sectors are separated further into industries. First, we will cover sectors, and you can think of sectors as categories. Stocks are added to a specific sector based on what its company does for business. Investors tend to break sectors into two types: defensive sectors and cyclical sectors. Defensive sectors are sectors that have safer stocks in them, and that can be an important part of your portfolio in a down market. But while being safer, they also aren't as exciting since they don't have as much of a high of an upside. Cyclical sectors are far more risky because they tend to rise and fall depending on the time of the year or consumer confidence. Now here's a list of all the sectors, and different things online will base different sectors and have different names for them, but this is pretty much the essential ones, and here they are separated into defensive versus cyclical. And on the left you have your defensive sectors like utilities, consumer goods, and industrial goods. And that is because utilities are things like your electricity or your water, and those bills and the prices for those things don't tend to change that often, so that's why it's more defensive. People will always need electricity, and your consumer goods are things like food and beverages, and people always need food and beverages, so even if the prices rise, people will still buy it, and it doesn't hurt the demand as much on that product. So a defensive stock can be good in your portfolio to help keep making you money in a down market. Now, cyclical sectors are things like retail and technology, where people are buying a lot of things around Christmas time, but not as much in the summer, so the stock doesn't do as well. And technology, when students are going back to college, they have to buy new computers and printers, and a lot of things for themselves. So, and whenever a new product comes out, technology stocks tend to do very well. But when there's speculation as to how many people are buying computers and now are switching to tablets, it can really hurt the market. So there's a lot of risk versus reward in cyclical stocks. That's why they're considered a little bit more risky, but there's a higher reward as well. So it's important to have both types of sector-based stocks in your portfolio. Sectors tend to be general by design. So to further identify a company's purpose within a sector, industries were created. Industries can be thought of as subcategories of sectors. And here I'm just going to list some of the industries within the sectors that we talked about in the last slide. Not all sectors have further subcategories of industries, so that's why they're not all listed here. But as you can see, it's fairly straightforward. Something like the financial sector is broad, so then they have more specific industries like banking, financial services, and real estate to further identify that company's purpose. Also with technology, you may have a computer hardware company or a telecommunications company to further identify what exactly that company does. And this is helpful in trying to find stocks that you would like to buy, because you should only buy stocks that you know a lot about the specific industry. If you don't know anything about insurance, you should not be in the financial sector. But if you work in the financial sector, then you're going to understand those stocks a lot better, and you're going to understand the rise and fall of them within their sector and within their industry. So as you will see in the further lesson about how to buy stocks, this is what we discuss, and the fact that you should only buy industries that you know a lot about and even that you work in, that you understand a lot better, because sometimes stocks don't react the same as you would think under a lot of different conditions, which we will go over. A stock exchange is essentially a list of stocks that are traded on that exchange. The stock exchanges are where shares of stocks are physically exchanged to and from buyers and sellers. Each stock exchange has certain requirements for a stock to be a part of that exchange. And I wanted to make a note of this because a lot of times on websites and a lot of different places they talk about penny stocks, but you will not find any of those companies on the major stock exchanges because they could be a company that exists today but are gone tomorrow, and they're much more dangerous. And hedge fund managers, which are managers of large billionaire type funds, aren't allowed to even recommend their customers to buy a stock that's below $5. So there are some stocks on the major exchanges that are around $1, a little bit below, but they can only stay on that exchange as long as they're going to become to be above $1, or else they will drop off that exchange and be on another one. So that's just something to be aware of. Now, the two major stock exchanges are the New York Stock Exchange, usually delimited by NYSE, and the National Association of Securities Dealers Automated Quotations. Now that name is never used and is always known as AKA the NASDAQ. And as I talked before, there is the composite index of this exchange. What's interesting about these two is that the NASDAQ, tend to be technology companies in this exchange, but also it is completely electronic. When you log into your brokerage account to make a trade, it is all done with computers. Whereas the New York Stock Exchange is like what you see in movies, where a person gets the share, goes up to another person, and then exchanges and tries to bid for those different prices, and then they come to an agreement. So the New York Stock Exchange does that along with some computerized trades. So that's just something interesting to note about the two exchanges. Also, Both of these exchanges are comprised of thousands of stocks, so they are considered the largest and most widely known exchanges in the stock market. So when you log into your brokerage account, when you go to buy a stock or look it up, you will see exactly what exchange it is on, and so you'll be aware of what stock you are buying within what exchange. So to round out this video, I wanted to give you a bird's eye view of how the stock market is structured based on what we just talked about. So here is 4 different stocks that are in different sectors and industries in a different combination to help you see how it works. So in the top left-hand corner, you have Disney, which is in the entertainment industry, which then falls under the bigger sector of consumer goods and services. Then you have Caterpillar, which is part of the heavy machinery and vehicles industry, which is part of the larger industrial sector. Then on the right-hand side, you have 2 stocks that are on the same exact sector, but then in different industries, where Cisco is more of a networking and communications industry, and Apple falls under computer hardware. From there, you will see that each of these also trade on different exchanges. So the left-hand side are traded on the New York Stock Exchange, whereas the right-hand side, since they're technology-based, they're traded on the NASDAQ. So if you went into your brokerage account to purchase Cisco, you would see that it is on the NASDAQ Stock Exchange. And the last thing, as an overview of the way that I set these up side by side, these different stocks can also fall into those indices like the Dow, the S&P 500, and the NASDAQ index. So to show you that best, you have Disney and Cisco, which are one of the 30 Dow Jones stocks. So those along the top-hand side are part of the Dow Jones Industrial Average, but the bottom 2 are a part of the S&P 500. So if you own Apple, but you want to see how well you are doing in the gains that you're making, you can look at the S&P 500 as a whole to see how well you are doing versus all the stocks in that same index. So I hope this is a good enough overview of everything that we just discussed and how the stock market is structured. I thank you for watching this video, and please continue to the next one.